Hi guys. Today we will analyze Church&Dwight stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. The short-term trend is negative, while the long-term trend is still positive. Strong support levels are around $87 and $81. Next strong support levels are around $72 and $67. Strong resistance levels are around $91 and $96. Next strong resistance level is around $105. In the last month the stock has been trading between $86 and $96.50 range. It is currently trading near the lows of this range. The stock has an average volume of 1.5 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 8% per year, for last 5 years. We see that the average profit margin of the stock has been around 16% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 111% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Church&Dwight Company: bad, average, and good. First scenario. Church&Dwight will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 14%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $66. Second scenario. Church&Dwight will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 15%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $82. Third scenario. Church&Dwight will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 16%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $101. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.15. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Church&Dwight, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 29. Again, I will use 3 different scenarios for Church&Dwight Company: bad, average, and good. First scenario. Church&Dwight will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 15. In this case, the fair value of the stock today would be $29. Second scenario. Church&Dwight will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future P/E would be average, 17. In this case, the fair value of the stock today would be $35. Third scenario. Church&Dwight will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 19. In this case, the fair value of the stock today would be $43. As you can see, today the stock is overvalued, $88, even if we expect the company's high performance in future. While the company has an average profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 5 to 6% yearly. Based on that, the stock looks overpriced at the moment. The company is not only facing intense cost pressures, but also softer demand within its more discretionary brands. So, I need an extra margin of safety with this stock. I may consider buying the stock when the stock drops to $65. Company's strengths. Church&Dwight Company is a major American manufacturer of household, personal care and specialty products. While it manufactures many products, it's best known for its Arm & Hammer line, which includes baking soda and a variety of products made with it, including laundry detergent and toothpaste. In 2022, the company is introducing a range of new products, including gummy vitamins and beauty supplements, under the Vitafusion and Zicam brands. The company is also planning 2 new condom lines under its Trojan brand, as well as additional at-home beauty products. It also plans to significantly expand production capacity for vitamins, cat litter and laundry products. As inflationary pressures shift consumer behavior from premium to value products, the company's offerings in detergent, vitamins and cat litter could benefit. Management expects the consumer shift to value products to continue, and is preparing to meet the projected increase in demand. The company has also addressed rising costs, in some cases, by reducing package sizes while maintaining prices. The company is a dividend aristocrat. It has raised its dividend for impressive 26 consecutive years. The stock currently has 1.18% dividend yield. The company's return on equity of 22% and return on assets of 9% are in line with the rest of the industry. Its profit margin of 15% is amongst the best in the industry. Risks. Supply chain and production challenges continue to impact the company's ability to meet demand, despite the addition of many new suppliers and co-packers. The company is also facing margin pressure from rising costs, and may need to implement further price hikes to offset additional cost inflation, not anticipated by management. In the current inflationary environment, the company's premium brands, 10% of its portfolio, are also facing increased competition from lower-priced products, which is impacting margins. The company also faces customer concentration and product concentration risks, with 3 customers comprising over 20% of sales, and 14 power brands accounting for approximately 80% of revenue. Church&Dwight is much smaller than its top competitors, for example Procter Gamble, with less resources to spend on research and development, and advertising and marketing. Analysts are also concerned about the durability of the firm's growth through acquisition strategy. For example, Church&Dwight paid a steep 6 times trailing price-sales multiple for Zicam Company, which is very expensive for a mature brand in a small subcategory. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 5 to 6% on average per year. The earnings per share is expected to grow by 8 to 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.